Welcome back to The Explainer. So, if you're a young professional trying to build a seriously secure financial future, but, without eating rice and beans for the next 30 years, you are exactly in the right place. Think of me as your personal financial mentor today. We're going to break down how you can dramatically accelerate your path to wealth just by making a few really simple strategic decisions right now. Grab a notepad because we're exploring a massive game changer today, the step-up strategy. Now, we've talked before about how investing just $10 a day can slowly grow into some serious long-term wealth. But let's address the elephant in the room. 25. Most people hear that it takes 25 years to build real wealth and they just tune out. And hey, I totally get it. If you're a beginner investor, waiting 2.5 decades feels like an absolute eternity, right? You're grinding away right now, and you want to see the fruits of your labor way sooner. It's completely natural to look at that timeline and just feel incredibly impatient. And honestly, that impatience, it leads to the ultimate question we all ask ourselves at some point. Is there a way to grow wealth faster without taking on some crazy, wild risks? Well, the answer is absolutely yes. But here's the secret. It's not about finding the next hot stock or timing the market or betting the farm on some unpredictable trend. Nope. It actually comes down to adopting one incredibly simple, almost boring daily habit. But this habit practically guarantees you'll outpace the average investor over time. To really get this, let's look at the tale of two investors, the flat investor and the step-up investor. Picture two people starting their journey at the exact same age. Both are smart, both invest consistently every single month, and both choose solid long-term investments. I mean, they're doing exactly what the textbooks tell them to do. But here's where the story takes a massive turn. After 20 years, one of these guys ends up with significantly more wealth than the other. And spoiler alert, it isn't because they magically picked better stocks. It comes down entirely to how they treated their growing income over those 2 decades. Over 20 years, the gap between these two is just massive. The flat investor's wealth definitely grew, sure, but the overall progress is kinda meh. Meanwhile, the step-up investor's wealth absolutely skyrocketed. Why? Because the flat investor kept their monthly investment amount exactly the same for 20 years, totally ignoring how much their salary increased. The step-up investor, on the other hand, consistently increased their investments right alongside their income. Over 20 years, that one simple decision to step up their contributions created a completely different financial reality. So what exactly went wrong for the flat investor? Well, they fell victim to a sneaky little trap called lifestyle inflation. Simply put, this is when you spend more money and upgrade your lifestyle expenses whenever your income rises. It's the number one reason why earning a higher salary often completely fails to build lifelong wealth. Think about it. You get a promotion, a nice raise, you feel amazing. But then, almost instantly, you feel the urge to upgrade to the newest phone. Then maybe you lease a slightly nicer car, throw in a few more monthly subscriptions, and before you know it, all of that exciting new income has been completely swallowed up by your upgraded lifestyle, leaving absolutely nothing extra for your future self. Let's break this down and directly contrast these two habits. On one side of the table, we have the constant lifestyle spender. Every single time they get a raise, their lifestyle upgrades, but their investments stay completely flat. They might look super wealthy on the outside, but secretly, they're just treading water financially. Now, on the other side, we have the disciplined step-up investor. When they get a raise, they intentionally direct a portion of that income growth straight toward building long-term assets. They are quietly, patiently preparing for total financial independence, while the spender is just out there buying depreciating toys. Which brings us to the core of the step-up strategy. And it's incredibly simple. As your salary grows, your investments grow. That's it. It really is that straightforward. Now, I want to be super clear here. You do not need to suddenly find thousands of extra dollars overnight to become wealthy. Honestly, that's a total myth. You just need to make gradual, realistic adjustments. The whole idea is making sure that your future self gets a raise at the exact same time your present self does. Let's look at how this builds with a really simple analogy. Say you start by investing $10 a day this year. Great start. But next year, using the step-up strategy, you increase that to just $11 a day. The year after that, $12, then $13. We are talking incredibly small increases here. Going from $10 to $11 a day is practically unnoticeable in your daily life. I mean, it's literally less than the cost of a cup of coffee. But over long periods of time, these tiny, steady bumps in your contributions feel absolutely massive long-term compounding. And here is the simple math of compound interest that every single beginner investor needs to internalize. Compounding begins slowly, and then it accelerates. Think of it like rolling a tiny snowball down a massive snow-covered hill. At first, it barely grows. You probably won't even see the results in month one or even year one. But remember, investing is not linear. As that snowball gathers momentum, the compounding accelerates. And when your contributions are steadily increasing right alongside that compound growth, the snowball effect becomes mind-blowingly powerful. This is exactly why patience and steady progress are always, and I mean always, better than seeking fast financial shortcuts. All right, let's make this highly actionable with a clear 3-step blueprint you can start using literally today. Step 1, set a base investment amount. Let's just say $300 a month into your portfolio. Step 2, experience income growth. This could be your annual raise, landing a new job, or honestly just getting a bit better at budgeting. And step 3, this is the magic step. As soon as that income grows, increase your investment amount by about 10%. By quietly automating these small raises, you're consistently investing more into appreciating assets, which creates a night and day difference in your wealth over the decades. But to actually pull this off, we have to talk about the psychology of money, because overcoming our own mental barriers is huge here. Very few people increase their investments with the same enthusiasm they increase their spending. So, I want you to adopt this quick checklist of 3 small habits to fight lifestyle inflation. First, explicitly recognize that urge to spend more the second you get a raise. Catch yourself in the act. Second, actively flip that behavioral habit by automating your investment transfers the very day your paycheck hits. And third, consciously direct that income growth toward long-term assets. Automating these small raises is the ultimate hack. It completely removes the psychological fear of investing more money. I really want you to absorb this quote. The goal is not constant excitement. The goal is steady progress over decades. Please, keep your expectations realistic here. This is not some magical shortcut to overnight wealth. The markets are still going to go up and down. Some years will feel amazing, and other years, well, they're going to seriously test your patience. And you know what? That is completely normal. Long-term investing isn't supposed to be an adrenaline rush. Avoiding those exciting, risky shortcuts and embracing calm, steady progress, that is the true, proven path to lifelong wealth. And that brings us to the actual tools we use. Why are low-cost ETFs the absolute perfect vehicle for the step-up strategy? Well, because ETFs allow you to invest broadly across hundreds of companies all at once. You're getting broad market participation. You're not out there gambling your future hoping one single company survives forever. Instead, you're capturing the growth of entire sections of the economy. When you combine the broad safety of an ETF with your consistent, gradual contribution increases, you are literally building an unstoppable, incredibly powerful long-term wealth-building machine. Eventually, as you successfully run this step-up strategy over the decades, your portfolio is going to get pretty big. And a massive, really exciting new question is going to appear on the horizon. How do people actually transition from building wealth to living off their investments? When you finally hit financial independence, do you just sell everything? Or is there a smarter way to create monthly, long-term income while keeping your portfolio alive and thriving? Well, that is exactly the crucial concept we're going to explore in our next explainer. Until then, just remember, small steps today create enormous wealth tomorrow. Keep compounding, and I'll see you next time.